How is my audio, everyone? Good to see you, early birds.
Sounds good, my friend.
Hi, Stace. Good to hear your voice, as always. Last week, there were protesters outside of in the street below. I figured I'd try it and make sure I had some earbuds in, see if they worked. Okay, we're 2 minutes early, so we'll just wait a few minutes, and as soon as Retro's here, and we'll start right on time. Hey, everyone who's been coming in the room. Retro, thanks for being here. We're good to kick off the recording. Let's just go ahead and start. All right, we're rolling. Welcome, everyone, to this week's Regenerative Finance Aligned Voter Committee meeting. I am Kianga. I'm a moderator for the group. Hello, Vigilant Frontier Research. We've got a mix of aligned delegates following the ABC. We've got Space Exponential, our AVC member, and other members of the community. So without further ado, imagining most of you have seen the announcement for what we're going to cover on this meeting. Since we've kicked off with we had our Atlas alignment vote, and we're now working with 5 scopes instead of 12, which means there's a different weekly cadence around what scopes we're meant to cover since last week. This week, the stability scope is in focus, and the plan for this meeting was to think about, a new kind of topic that would be relevant to the stability scope in general, but doesn't actually deal with the governance particulars that are facing the community right now, and some of the scope language that will, try to work on that async, but use this time. And I thought I could draw a little bit on my personal experience to maybe share some concepts that are sort of involved in some of the risk analysis that needs to happen, that's taking place at the scope level. So I will kick off in a moment some of the things I've been posting regarding credit downgrades and rating agencies. But before I launch into that, and this is a ask me anything, so I hope we can be a little bit of a discussion. And even if it's with the chat feature. Vigilant stability scope. Well, I looked at the new schedule, and it says that in the 8th week, are we in the 8th week retro, or whichever week we're in? Yeah, I mean, we've just basically reverted to the new schedule, which I think says the stability scope. So I don't know. Ecosystem or governance will let us know if we're off. It seems like all of the AVCs are covering different things, and I'm not sure. Maybe in the next quarter we'll all sync back up on the same week. So yeah, I mean, whether it was covered in substance in the 12 scope schedule, we now have a new schedule, so we're going with the stability scope, which anyway I think is needs a lot of thought and discussion. It's very core, and certainly has evolved since week 1, which was around April. The first 2 weeks of April, we were talking about ALM, and I'm sure that all of the delegates here have a mountain of work on your plate to track proposals that seem to be coming at lightning speed. The cadence, I'm not sure how many of you have prior experience with governance at Maker. So we're mindful that there's a lot on a good day, there's a lot to digest and learn, and it takes an enormous amount of time to get your bearings. But then now we have a really rapid cadence that I don't think I fully grasp, but seems like we're seeing posts from ecosystem actors, facilitators, recommending certain changes, and then like within a day or a couple of days, it's time to vote on them on the polls. And I think from a policy perspective, I'm a little bit concerned from governance when it's something big like, say, the Andromeda deal. I spent a little bit of time looking at that, but not tons. This is an evolution that's been in the making for many, many months. And I don't know how the delegates are feeling, but it seems like it is obviously not possible to sort of get your arms around and probably review what's an entirely new structure of the deal from what I glean. And then I think those would just hit the forum. I don't even think there was like any pre-announcement saying it was coming, right? So I think that process could be, maybe that's an area we can think about in our policy documents, the cadence of when polls are requested and how much time delegates should have to digest, because we're not going to be involved in the day-to-day micromanaging, are not likely to be necessarily up to speed on all the things that are happening, and there's not a lot of transparency in that. And so to get things fully baked and then have to digest and vote on them in less than a week seems that we want to look at that. And maybe that's fine for some things like reducing the debt ceiling on the Paxos dollar down to 0, for example. But if it's an RWA structure or involving, well, that's RWA as well. We'll get into that in a sense. These centralized stable coins. Yeah, this will take some thinking, and it's really a question for the delegates, right? So Vigilant's saying, I asked of Alpha how to handle this, and they said it's best to cover each of the 5 scopes twice at least. The governance scope should be this week. Well, how are you, Bona Publica and Vigilant, deciding this? Because I don't have the link with me, but I feel like it's explicitly stated in one of the scopes what we're supposed to cover this week, which maybe got my math wrong in terms of counting of the weeks. But anyway, we're going to roll with stability scope. And we're not going to talk any further about the scopes. I wanted to talk a little bit about credit, sort of rating agencies and ratings on debt instruments for centralized counterparties in traditional finance. And Bona Publica, sorry, pausing to read. Bona Publica saying the Andromeda proposal is a significant real-world deployment of DAI with the purchase of U.S. Treasuries. It is significant. Yes, absolutely. And so what's happening with the stable coins, is very complicated, and there's not really a forum for people to get educated, right, about what the provenance of these deals has been. They've been in the works for quite some time, but have been the approach has been revised to fit in with the end game structure. And I know I'm not aware that there's been a forum to really understand that or learn about that, other than just, trying to absorb information that's in a post, which can be very challenging, if not impossible. Navigator saying Maker has a fair few of these principal agent dynamics. It's tricky and it's not clear which or whether governance actors should step in or at what point that should happen. Absolutely. And, functionally, the AVC, our input is coming at a much slower, longer term cycle, obviously quarterly cycle. And, we are thinking, we've been, it's been very specifically outlined that we're thinking about these advisory committees, and that role is going to fill a lot of the gaps, but that there aren't a lot of people or organizations in those seats. So the good news is that we have in this community tons of enormously talented and experienced people who know what they're doing and have been doing it for a long time, and things are kind of on rails. And it's just a matter of, I think, governance catching up somewhat, and for the delegates, good luck with it. Good luck. Good luck. So let's move on to the sort of broader topic of regenerating traditional finance. So I wanted to raise this as a concept to keep in mind where refi is concerned, that of course we're talking a lot about regeneration in terms of our planet, our communities, our food supply, financial inclusion, a lot of kind of impact, put impact in quotes, topics. But what's maybe overlooked, but equally important, I think, is the concept of regenerating finance itself. And so that refi CVC policies really should draw a link between, this kind of outcome in the real world for people, for places, that understands how important the changes are that we need to make in the traditional financial system, which is the central project of DeFi in and of itself. So, in that vein, I was very excited and I put a couple of articles in our channel. But this project Levon, let me see in the chat if anyone knows what that is, or if anyone wants to come off mic and give a brief, like 2 sentences on what that project is. First person to write 2 brief sentences. Gets a sticker. Kidding. Nobody knows what that is. See, there's so much going on. So I'm referring to the announcement by Block Analytica, which is the former risk unit, members from the former risk core unit. The only advisory council actor, I believe we actually have in the entire ecosystem. And they are advisors for the stability scope and have begun a project to create credit ratings for users of DAI vaults. Yes, thank you, Paper. I knew I could count on you if all else failed. And so it struck me, it's really kind of still at a conceptual level to see maybe the leaps that the chain, the domino effect of what's being started here. I don't want to spend a lot of time. I certainly don't have the background or the knowledge as to what has been developed thus far, and I don't intimately know their roadmap for it. But the idea is that, we will one day in DeFi have credit ratings, the ability to observe an actor's on-chain payment schedule, their assets, their defaults, and come up with something, a spiritual cousin to what we have in traditional finance, the dependency that we have on rating agencies. And for refi, this feels like the key unlock, the key gating issue that is going to kind of keep many projects and people and communities still struggling when you don't have access to capital. So right now, it's great to be able to have X amount of Ethereum or other digital assets and then borrow DAI. In some sense, you could say borrow maybe isn't a misnomer if it has to be over collateralized. So you actually have to have more wealth in another asset than you want to borrow. So that's sort of not a situation that a lot of regenerative projects are in. So the current structure of how DAI is generated, or how you quote borrow DAI, doesn't really help people who don't already have significant assets. And so the future of, I think, regenerative finance looks something like being able to develop a kind of on-chain reputation, credit history, credit rating, and then use that to be able to finance projects. And so that spark of just beginning to develop a product seems incredibly exciting and really worthwhile for an ABC to talk about a little bit, because it's beyond where we are today in terms of execution. It's a little bit beyond a number of the specific proposals of amending the scopes. But we wanted to look at, what are we trying to achieve? What do we think the road looks like, and why? Like, why do we need an alternative to traditional finance? Does it need regenerating? Because I think where the topic of real world assets is concerned, there's definitely lots of different takes on the value proposition for MakerDAO and the sort of attitude relative to traditional finance. Do we want to just kind of upgrade the current system with faster spreadsheets or a little more transparency so we can cut out some fees? Or is there something incredibly novel or something entirely new that we could bring to the table, that we can bring to the world that only decentralized finance can do? And I think now at the inception of the scopes and the end game, it's something ReFi wants to keep front and center, which is the extent to which we're depending on traditional finance. Now, there may be an economic interdependence right now. DAI is being pegged to the dollar-denominated assets. There's a whole strategy for what's happening in the stability scope that's important to understand. And you can see in some of the legal reviews, the analysis of what centralized risk we have with the reliance on those stable coins. But one of the things that I wanted to drill down on in this call is just particularly this question of the rating agencies. And I'm not gonna look at the chat. I'll look at the chat in a few minutes because I see good stuff there. But I'm also mindful that leading up to the end game, or leading up to this year, earlier in the year, there was a lot of discussion about how we're monitoring all the stuff that's happening off chain, right? We have the real world asset deals, but then we've seen how vulnerable the stable coins are, that the stable coins are a real world asset product that the ecosystem's highly dependent on, that DAI is highly dependent on. And what are all the things that can go wrong in the real world with traditional institutions that then can, really cause us problems? And there's been some suggestion that, we should bring in rating agencies we should bring in Moody's to come and work with us as advisors on how to craft a framework to understand the maker vault debt risk, for example. And so this conversation will just take a little bit of a closer look. And I've put a bunch of articles in the channel. And so it's certainly a topic to discuss async, because there's just way, way, way too much to try and cover in this meeting. But when we're seeing the work that Block Analytica is doing on the one hand, that Maker's pioneering around there being eventually a rating that can be ascribed to a particular borrower or user of some of what the sub-DAOs are going to build. And eventually you might imagine that, this can become a real institutional product, a real reference point for not only decentralized finance, but when we have the infrastructure inversion, will be the standard, right? The way that things are being built here will be the standard for all of finance. So let me pause there and just check up on the chat. Right, Libertas. That fits with ReFi well. Yep, it provides credit access to communities who are currently excluded from the financial system. Right, so permissionless credit, access to credit as a value proposition or as a policy objective for what MakerDAO's going to build, at the sub-DAO level eventually, is definitely something we want to keep top of mind. And there's going to be lots of friction with the regulatory requirements and, keeping things permissionless, uncensorable, resilient. It's a challenge, but I just wanted to tie that challenge and highlight that is really key for refi, that ultimately the projects, the impact we're thinking about, they struggle because there's not a good business model. The traditional finance system does not provide a market mechanism for many of these projects to actually make sense or be sustainable. So one of the ingredients for there to be a kind of permissionlessness on chain would be, solving for privacy, the ZK proof stuff, but then also, this idea of credit rating, because, I'm certainly not the one to give a broader history of or description really of what a credit rating is. Obviously, every individual, and I'm speaking in the US and from a US perspective, so please bear with me to the extent, this is not applicable in other jurisdictions, or if you're on the call in other areas in your how things are organized in your country. The consumer credit is sort of one area where people have their personal credit ratings, and then you get all the way up to the publicly traded companies, and nations even have their ratings on their debt obligations, which is supposed to give some indication to the market of how trustworthy and financially sound, and influences the cost of capital, right? So if you're perceived by these all-powerful rating agencies to be a good credit risk, like you pay your bills on time, then you can borrow money for less. So what refi, what the regeneration looks like, is that there's these other tools that open up the possibility for many, many more people with different backgrounds and maybe novel business ideas, that there becomes an efficient market that can fund and sustain that activity, and something different from philanthropy, something different from grants, something different from what we see in impact investing today, right? What is the unique thing that DeFi can bring to the table? So these are some of the points, I think, also from sort of like a political and policy perspective at the national and the supranational level. The battle we're having for mind share, and what is the perception of our value in the world? Are we perceived as degenerate, like gamblers who are just perpetuating scams and casinos? It's like we've got to talk, I think, a lot more about what DeFi and crypto obviously can do that is an improvement on the status quo, and why, and not just an improvement because some small group of people get to make a lot of money, right? That's sort of, which is great, but in terms of the broader historical arc of, I think, what we want to put out in the world as to what's possible, the credit rating agencies and their track record and how credit ratings work in traditional finance is an excellent area for us to double, triple down on, as to where what we're doing here in this meeting and at MakerDAO can absolutely be 100% for the public good. So I put in our channel a couple of articles. The Silicon Valley Bank demise began with a downgrade threat. And why talk about Silicon Valley Bank? Many of you on this call will appreciate, will say, when DAI depegged right? When USDC had a problem, and kind of the interlinking dramas around that. And so we very much are interested in what happened to Silicon Valley Bank. Everyone in the world involved in crypto is very interested in what happened to Silicon Valley Bank and why. And so what's interesting is that, and I won't go into all of the details, and I only know what I can read in the news, but their credit rating was about to be lowered. And you can read the article and get their take on how that led to what eventually happened. But I thought it was kind of funny as I was thinking about this meeting is that 21 years ago in the United States, we had our largest corporate bankruptcy at that time, Enron, also famous. Famously, the gentleman who's taken over FTX was like the restructuring lawyer for Enron. The criticism at that time was that the agencies didn't act soon enough. So if all the market is trusting, right, everyone's trusting these very important, prestigious, centralized institutions who have unique access to information, right? They have unique access to the financials and what's going on. That's their job. And the market is now watching what they say, what they do, what ratings they apply to, whether it's a debt instrument or whether it's a counterparty rating or rating for the country that I'm in right now. The world's been wondering if the United States is going to default and, we're going to get another credit downgrade like we got in 2011 that really hit markets hard. So, all of the information is privately held, is non-transparent, is certainly off-chain. And so everyone has to trust what these institutions say in the form of these letters and numbers, that they have produced a matrix of letters and numbers that correspond with, a certain level of risk. And so you can see in Silicon Valley where the threat of the downgrade ended up causing a bank run and collapsing, that, creating a whole systemic event. In Enron collapsed and the rating agencies had still had not even moved. So there was this criticism of like, well, how did the rating agencies not warn anybody? How did they not know? How can Enron go bankrupt with whatever their great credit rating had been? So there was no reflection of the deteriorating situation in the actions of the rating agencies. And so that was a big critique at the time. But the flip side of that coin is like, well, how do you manage that when you see the Silicon Valley situation last year? You could then say they were on it. They didn't do an Enron, but then what happened anyway? And then I also added another link to a discussion that came out of, what happened with the great financial crisis, 2008. And these are very exotic instruments that were stacking mortgages. And it was, I was part of this industry as an attorney at the time, and it seemed all very clever. It seems ludicrous now. If any of you have seen the film The Big Short, this idea that you could take, say 100 mortgages where the borrower is like no income verification, no collateral down, basically your worst credit risk. You could take 100 mortgages of the worst credit risk. And if you slice them in tranches, you basically say, well, the probability that they're all going to default at the same time is 0. So you're doing lots of fancy mathematics. And you can come up with a product that has a AAA rating that's filled with garbage, but because the default risk has been assessed in a very creative way, they came up with this unbelievable, system. So there was a lot of blowback after everything blew up with the rating agencies. I mean, the product itself was flawed, but then the question of, kind of how cozy the conflicts of interest. The rating agencies were making money hand over fist because Wall Street had come up with these great product, these booming markets, and they get paid to rate instruments. So there were questions about that conflict of interest. There were obviously, there was a long debate. I shared the article that would, Council of Foreign Relations is still talking about it 7 years after the financial crisis. So I do want to, I think we want to caution, even as we have the entanglements with real world assets and we have dependencies on real world institutions, that we're still very critical and thoughtful, that is not necessarily our standard. So when we're hit with we're unregulated, or it's not, or even, our internal, it's kind of a weird schizophrenia, if I may, when I see arguments pushing, I can be quite hawkish. I have a reputation probably of being outspoken, or fudding some concerns over the past several months with different centralized counterparties. And sometimes the response I would get on the forum is, oh, well, they're regulated. So I think it's kind of really interesting how DeFi, or some aspects of DeFi, have gained psychological comfort and have even made arguments as to why we should depend on the legacy financial system, or that it's okay, or we're not, quote, worried about Circle, or we're not worried about Coinbase because they're regulated, when we're at the same time arguing that we're not coming from a regulated place. I think, we have lots of arguments for why what we're doing doesn't fit the regulatory structure that's in place right now. And so I think in refi, for the refi ABC, as we're thinking about policy that impacts, all of the scopes, not just like the charitable purpose stuff, but this is also what refi looks like when we're looking at the stability scope, for example, where we're thinking about centralized counterparty risk who are issuing the assets the DAI is depending on, or the PEG is depending on. And, one of the only ways, the only warning signs for the market when it comes to an institution like a Coinbase that's publicly traded, that has public rated securities, or, whether they were Silicon Valley Bank, but also California, SI, Silvergate. I'm just trauma blanked out, trauma memory loss of the names of the firms. But, we don't have transparency that into necessarily what's going on economically at those firms. We are, as a protocol, trusting quite a lot, and we have to. We're managing risks. We have got goals, but I think it's important that we're not complacent, and that we recognize. And I'm preaching to the choir. I realize that because an institution is regulated, hasn't seemed to really been that helpful. Whether it's whether regulated and or has these public ratings. So we can go from the 20 some years since I've been out of law school. It's just been a parade of catastrophes. And so I think this is our opportunity with DeFi, and that's why, again, I'm excited about the credit product, because this is really the moment for us to show the products, right? It's not just sort of to talk about it, but it's to have the dashboards that outsiders can understand and really draw the comparison, the links that say, well, perhaps, in Enron, the rating agencies didn't react soon enough and the company went bust. In Silicon Valley, the word got leaked out early and the company went bust. So maybe there's an entirely new approach that the world needs, instead of, committees of people around the world adding more and more and more layers of rules on something that is, perhaps fundamentally flawed. And so, in terms of information, right, we're going to find out in practice, but you might imagine if the markets are efficient, that the transparency we're able to do in DeFi, real time, could potentially, really prevent these kinds of shocks and panics when a small group has access to information, knows the information, they can act. I mean, that's another issue. But when so much information, such a change of information gets released into the market all at once, it's going to be disruptive. And so something that DeFi can offer in this sort of real time, being able to take the information we have on the blockchain, and certainly as the space scales over the next couple of years, translating that from the raw data and the interactions, and then, bringing them into crypto native credit scores, or even then, all kinds of dashboards that will begin to be built, so that it's not a surprise. The market's never going to get surprised. The market's going to know real time. And frankly, if the regulators have these, the self-reporting regimes in the United States, the membership organizations, so many of these rules are designed because we didn't have a way to have openness and transparency, right? And so rating, the dynamic around the rating agencies has been, I think, a really, really good particular aspect of traditional finance that also ties into the safety and soundness that is at the core of the arguments or the talking points, the friction that this industry is receiving. And it's sort of, and, granted, DeFi did have some cheerleaders, or there was some recognition of it performing well. I don't know that the nuance is that apparent in the broader conversation. But the domino effect of what can happen around credit ratings is really something to keep an eye on, both in terms of our own internal risk management and the benefit that we can also be a part of in terms of regenerating traditional finance. I just will pause and check the chat. And then I just wanted to close out, talk to you all about that tweet that I shared. Let me see what's been going on in the chat. Are you all still there? Do you like this edition of Kianga Radio? Jan Sky, I have to just ask you directly, I'm very confused by this post. I want to emphasize the importance of delving deep into the topics we'll be discussing in today's governance scope meeting. Where are you getting this? This feels very disconnected from, this is not about governance scope. I don't know if maybe it should be, but it's not. We've announced this is about stability scope. And have you been listening to what we've been saying in this ABC meeting? That generally our vision for these meetings is to maybe have a different kind of dialogue in the community, and talk about sort of some of the existential issues, some of the theory, some of the policy, the vision, where we want to go, current events, and that, we're not always going to be hammering the sort of maker meta governance. We want this meeting over time to be attractive and interesting for people who are even not in governance, who are not familiar with Maker. And so I just kind of find sometimes your comments to be odd. I don't know. I don't know where you're getting these comments. It's just self-generated text. I don't know. Okay. So nothing more. I'm not picking. I am picking on you, Jan Sky, but it's because I care. And I appreciate you being here and how engaged you have been. So I put it, if you scroll up to the top of the chat at the beginning of the meeting, I wrote a tweet thread back in January that I'm very proud of. And you all have to suffer. You have to suffer what happens when someone creates an AVC or is part of an AVC. You get to have a little bit of a platform to do what they want. So I'm making you all look at a tweet that I wrote. I care too much. I do, Faber. Well, so do you. Faber, so do you. But it's fun. It's too serious at Maker right now. I mean, this is such dry stuff, and then mostly no one talks. And I know that's now becoming more complicated with the anonymity and privacy. But I personally, culturally, don't think that the organization is going to scale well or do well if there aren't some forums where there's a live social dynamic where people can still talk to one another, and maybe even there's some forums where people want to share their screen. The human element and connection. You can't make paper here. It's a lot less in spring. I know. Well, you notice, Paper, that I am a AVC moderator. So that's a lot less pressure than what you were doing. Okay, so I won't. I'm not going to spend a ton of time, I guess, going through what that tweet is about, sort of line by line. I wasn't able. My security settings on my computer do not allow me to screen share. But basically, it'll just give you like 2 minutes of what that tweet is about and why I think some of those traditional finance concepts are helpful for us to get our head around as a community. And we're dealing with the outside world, and we're relying on centralized firms. And I'm suggesting that we don't rely on credit agencies for all the reasons that I've talked about and all the evidence I've shared over their track record for 20 years, which is that the credit rating, and so I have a background in derivatives, and I worked a lot with the ISDA. It's something called the International Swaps and Derivatives Association Master Agreement. This is another kind of global structure that had a cameo in The Big Short. You know, these were these gigantic trading agreements between large counterparties, between the large banks, large corporations, that cover, you know, certain types of product and risk that they have. And so the tweet that I shared in January, because there was, you know, some news of a downgrade of Silvergate, and it's like, okay, so what, right? What does that mean? And what I was interested in at the time was not this necessarily why were they downgraded. Like even with Silicon Valley Bank, right? It was sort of a downgrade because the value of some of the assets they were holding were going down, and but it's the second, third, it's the domino effect. You know, what we've got to really be smart about to scale Maker are the ripple effects, the contagion effects of when one thing happens. You know, it's not just that one issue, but like where else structurally do we need to look? And so in January, when I heard about this downgrade, I immediately thought about, does the bank have derivatives contracts? That's just what I know, that little slice of finance. And I know that in those contracts, they're bilateral contracts, And the way that these two large financial institutions manage their credit risk with one another is they have all of these provisions and triggers, things called defaults, things called cross defaults, that are tied to credit ratings, specific credit ratings. So I can have an interest rate swap. I can be JP Morgan and Silicon and Signature Bank, or not Signature, who is Silvergate. And that's not what people are thinking about, right? It's a commercial bank. People are looking at their deposits. They probably should have had some interest rate, or now think about Silicon Valley Bank. It's like, where were their interest rate derivatives? Like, where were their hedges in case the value of their bond portfolio went down and things like that? So when you're talking about these large firms, even like a Coinbase, they have internal treasury departments that are doing all kinds of other financial whirligigs to manage their risk totally separately apart from like their primary business that's in the newspapers, right? That they're a commercial bank or they're a crypto exchange. And, this is what I also experienced at Lehman. I was an attorney at Lehman when it went down, and it's basically a run on the bank. Silvergate can have a credit rating downgrade, and then they've got a contract with, Goldman Sachs or some other large firm that's providing them with other financial products, and there are terms in all these agreements that I say cross default. So it's like there can be and not just a cross default between entity A, that's your direct counterparty, but if entity A has any subsidiaries, national, international, those can also be kind of looped in as part of a family that will give a counterparty rights to take action, seize collateral, basically do something that's going to weaken the financial position of the counterparty. So, one of the things as we think about jurisdictional risk for Maker, it's not always so simple as to say, oh, we're going to not do X business in the US, or we're not going to do Y business with this US entity. That because we are contracting with a subsidiary or an affiliate that's in another jurisdiction, then all of our problems are solved. It's not really that simple, because the US entity, and I'll pick on Coinbase, not that I know anything in particular about Coinbase, but just structurally, it's the most significant for us, and it has this profile where, and I want to emphasize, I don't know, I haven't done the diligence as to whether Coinbase has any of these type of contracts. I'm just sort of sharing, hopefully something useful about how these types of institutions may do business, what these types of agreements look like, where a counterparty that's facing a US Coinbase entity, a large bank or what have you, might know that if, it's relevant, like if a subsidiary defaults or goes bankrupt, that could be an indication of financial trouble, right? So you have these agreements that are going to look broadly, when I'm speaking of agreements in institutional finance that are bilateral, that are going to look broadly across an international company at we want to have an ability to protect, our risk against this company, no matter where the problem starts, no matter where the fire starts, counterparties want to be able to act quickly. And so that tweet, if you're, interested in delving, I'm always happy to nerd out. It's pretty obvious. That's like nerd out on this stuff. The domino effect that can happen when a credit rating gets downgraded, and it may not only cause a bank run, but it could cause, another counterparty that has a contract with that institution to have rights under their contract to basically seize collateral. So, this is kind of what happened at Lehman Brothers. And what I was doing in the summer of 2008, the only thing I could get done as a lawyer for the commodities business was amending our collateral agreements, tightening the time frame between when there was a failure to pay and when there was an actual default. all the counterparties wanted more collateral. And so they would only amend, they wouldn't sign new agreements, they wouldn't do new business. It was everybody across Wall Street probably tightening things like ratings. So, these agreements might say that if this rating drops to this, we need this much more collateral. And so, these are the kinds of things that you can look for and maybe identify the beginnings of a systemic problem, or at least know where you want to look, and even just know the questions you want to ask. So this is obviously not for AVC members, not for delegates probably even, but maybe these are the types of things you want to look for. And I don't know if this would be the role of advisory council, but what questions would you ask as you're structuring these deals? The contracts that many of them are not able to be public. Are the people, working on the contracts, really pressing centralized businesses? Because I think, a lot of times it's just even sort of knowing the risk profile helps you work out what needs to be in the contract to protect maker and maker holders. And, this will apply very much to the sub-DAOs who, over time will be, really taking over all of these kinds of risk management dynamics. Right now, it's something I think for all of us to be thinking about real time with our stablecoin portfolio. And obviously, the entire portfolio of collateral, real world assets, stablecoin, decentralized collateral, these centralized issuers, the companies that we're going to have to deal with, being careful not to take too much comfort from, they've got X credit rating. Or if you see a kind of credit rating event happen, think through, okay, well, what are the other dominoes that could fall internally for that company? So, you might be very happy that they're regulated by the FDIC. I don't know, maybe that doesn't make people as happy anymore. Or maybe now we've got the blank check. I don't know where that's shaping up, but it's I think part of regenerative financial practices or regenerating finance is really exposing or I think, showing the things that we can make transparent. And I say we, decentralized finance, the new structured endgame, what we can make transparent that today requires such privileged access, requires knowledge, information is not on chain, contractual relationships. We're doing things from the inside out, absolutely inside out, and that there is so much good. There's so much positive to share about that. But we've got to fight fire with fire, right? I mean, I think we have to learn. We've got to learn the traditional finance structure, and I think we've done a good job. And I'm just speaking really broadly, we industry. I think we talk about what we're building, and it's very bespoke, and it's pretty much incomprehensible. I think then this next wave over the next couple of years, we could achieve so much to speak their language, right? Sort of take what traditional finance is set up with and talk about the two things together, describe what it is that we're doing in the context of what's already built and that's broken and how what we're doing is better. And so, these are just some of the weeds that I see in the traditional finance system that absolutely need to be completely ripped up and replanted. And that we're doing that at MakerDAO, and that this project that's been announced by our dear friends at Block Analytica, in all the things that are going on in Maker and governance, refi definitely putting a little asterisk by that as something that's going to be transformative, not just for Maker, but for DeFi, but also, we're going to put some fire under the rating agencies. We're coming for their lunch. Yeah, BA Lab stands for Block Analytica. All righty. Bona Publica says, perhaps a day will come when smart contracts are developed to act as master agreements and more advanced risk management systems will be available. 100%. And I'll tell you, ISDA, I haven't followed this really, but they're also trying to, this is the case in all traditional finance, right? I mean, ISDA is trying to put its smart contract up its infrastructure. And I was on a call, well, maybe it was last year, because I thought, oh, well, I'm really going to be interested in this. I'm going to be interested in what they're doing around blockchain. And I just was like, wow, they just don't, this is not going to it's not going to work. And so if, crypto native, I would say from a US perspective, there's a small window. There's a window, this uncertainty is a golden moment to build a moat, because this is just opinion. It's not legal advice, investment advice. It's just sort of my opinion. When the presidential election is over here in the US, which is going to be next year, I would highly doubt we get anything done before then. But there will be rules that come down. And when the large incumbents are able to fire up their business models around all this, it's going to be a sight. And so, we can do a lot to be very, very competitive, because it just is something that can't be, I think there are ways that traditional finance can never, ever, ever compete with what's possible for this group to do. But not with all the money in the world, not with all the senators in their pockets, but we just have, I think a good grace period to be really effective and really thoughtful and really smart, and all on the up and up. That these are things that you all are part of, that are running circles around what has failed over and over and over and over again. And so we don't want to take too much comfort. We have to deal with the real world, and we are. And I mean, I think refi doesn't have any kind of decentralization kind of purity. I mean, I think that's sort of very contrary to in many things that refi is really trying to do. It's like, well, we need this to connect to the real world, and we have to be very realistic about what that's going to look like. We need that to connect with people and traditional finance, but in the right way. And I hope that we can all be a part of that. So I've gone 1 minute over in my monologue. I apologize. Thank you all for tuning in. I hope it will be useful archival material as refi develops its views, and hopes to make a really positive impact on the culture here and the work that's being done here. And it's tough. Each of you, I mean, a lot of you, obviously, I don't know exactly who you are, but those of you I do know, I know, you work very hard and care, sometimes at different degrees, at different days, on the work at Maker. There's a big world that's going to be impacted by what we do here every day, and that needs to be impacted. And so I think it's worthwhile. All righty. Well, have a great rest of the week, everyone. This was officially it. I'd love to have dialogue async in the channel, so don't be shy. It looks bad when there's just walls of text. It's just me. It's just me posting.